Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth. With you this afternoon on March 11th, 2021. 1 year ago, the WHO had declared the COVID-19 pandemic. So it has been a year none of us will forget anytime soon. I hope this finds you and your families well and healthy and almost vaccinated. We're getting there, folks. It's been a trying time, and our hearts and thoughts go out to those who have been suffering. But let us move to the matters of Wall Street and the matters of investing. This is an update video of a call we did, a video we had done about 2 months ago, January 25th, I believe. That was a sector call, a tactical sector call on the energy sector. And I want to just give an update to our thinking in that regard. Allow me to share my screen with you, and away we go. Okay, so in front of you, you can see our take on the sector and what we're thinking about. So on January 25th, as I said, we came out with this sector call, and it was on the energy real asset sector. You can find that video on our site. Feel free to click on that. It's perhaps on the invitation you're receiving in your inbox. Since then, the energy index has appreciated by more than 31%. That's in less than 2 months. So we're very excited about that opportunity to provide to our clients. It's been a good run. Question, of course, is, well, what happens next? And that's always the magic, right? So as this update will discuss, we are still firm believers at ALINE Wealth in that the inflation will be higher in the coming months and years, and that investors will be rewarded for increased exposure to such things as energy, natural resources, commodities, and real assets. So that's our take, in this regard. And let's unpack our thinking and to give you a sense on how we're thinking about this opportunity going forward, and why we think this has some momentum. So our thesis: inflation is coming. It's very insidious inflation, right? It creeps up when you least expect it, and it stays longer than you want it to do so. Sort of like a flu, I guess. And to that end, I think many folks get surprised when inflation finally hits the tape. And so what do we have, right? What do we know? What are the knowables? We know that never before have there been spending by governments around the world. So it's a global situation where spending has been off the charts as much as it has been in the last year. So that's number one. Number two, we have never had as much debt in the global system. Number three, we've never had this much of they call it M2, or money in motion, or money supply, the money supply growth. And so so these factors are coming together at all at the same time, all globally, and it's mammoth amount of capital sloshing around. What we do know is that historically, economically, that leads to inflation. And so that is our sort of knowable fact that we're using to make this thesis. And what do we do? And how do we hedge against this? And how do we protect assets? And how do we grow going forward? We believe that commodities is exposure to real assets, be it natural resources or commodities or precious metals or energy, makes a lot of sense. So here's a bit of a sense on the global debt levels, and here you could see the run up since the COVID crisis of last year. And again, this is global, folks. We're not talking about a couple bucks. $270 trillion. It's a lot of cake, and it's sloshing around. And when that happens, it typically starts the fires of inflation. Therein lies our concern. You could see here the debt to GDP ratios for different countries around the world. Lots of debt, deficits as far as the eye could see, printing currency, all M2 growth, all support this thesis. So here's the the growth of the federal debt and it's only getting more, because you see we obviously just passed today. The president just signed the $1.9 trillion COVID Relief Act. So we're seeing more capital coming in, more money being spent. It's going right to people's pockets, and that is inflationary. To put it in context with respect to the great financial crisis of 2008, which I would have thought would have been the worst experience one could go through economically, but it looks to pale in comparison to what we've seen in the 2019, COVID-19, 2020 and 21, this American Rescue Plan. So here it is, 6.1 trillion, and this is just the U.S. and all the other countries, right? You get my point. A lot of debt, a lot of deficit, a lot of cash sloshing around. It's fun while the music's going. Hey, listen, we're all dancing. The question is, who's going to have a nice, comfy seat when that music stops? At Align Wealth, we insure you to do. We'll do that for you, because we're always balancers. We're going to balance the market and balance your portfolio so that you're always going to have that comfy seat right there ready for you when the markets and the music stops. This is M2, and you can see here that increase. Right, look at this dot. Boom. I think it actually ended up being 26% over 2020. So the case for energy and real assets going forward. Here's commodities since 2008. I mean, what asset class has been down since 2008? You can't find one except for commodities. So, in the metrics of regression to the mean, and the thinking that many financial folks think about when they think about investing, is they always want to go against, what has gone down goes back up, and the idea of the regression to the mean. Well, commodities would certainly be an oversold asset. It has ticked up so far in 2021, as you could see here, but it's got a long way to go. So that's one data point. Then we have the valuation data point. This is a couple of weeks old, so you're seeing it's bounced a bit from here, but still underweight in the S&P, high dividend yield for the most part, and unloved. That's the energy sector. You can see here also price to book, price to sales. I mean, the S&P is trading at a 3 or 4 times price to sales, as unbelievable as that is on an average. And here's energy at probably less than 1. Maybe it's a little bit higher than that now, much lower than the S&P. Gold miners, less than half as expensive on an enterprise value EBITDA metric versus the NASDAQ 100. So when you're looking for assets, when you're a steward for other people's assets, for other people's portfolios, their dreams, their aspirations, their college for their kids, their retirements, when that's on our shoulders as their fiduciaries and as their stewards, and we take that on, we take at Align Wealth, we take that responsibility on. And when we do that, we've got to act in such a way to say, what can go wrong? And so when we're looking at asset opportunities, when we're looking to allocate capital, we're always looking for those assets that give us that margin of safety, right? The ability to go into an investment, but sort of have that safety valve, And if you're buying something on a cheaper level, historically, you have that. You have the safety valve of buying something that's less expensive, and that's exactly what we're seeing here in the gold miners. And these gold mining companies, by the way, have really changed their DNA, if you will. Better management, more focused on shareholder value, more focused on dividends and payment and cash flow to investors, much more shareholder friendly, less focused on trying to grow for the sake of growth. In the previous cycle or two, these companies would just do mines anywhere they can, and despite the fact they may be too expensive or uneconomical, But today, that's not the case. They're very focused on their business as a shareholder value play. So we think that's good. Folks, thank you. Look forward to discussing this with you. Feel free to reach out to us at ALINE Wealth and to discuss in greater detail our take on the markets and on your portfolio and how best we could optimize that. Thank you for listening, and have a great day.